financial leverage. What is financial leverage? In financial leverage, I try to answer three basic questions. The first one is, how much do we have in borrowed funds compared to our total assets? Second question, how much do we have in borrowed funds compared to the stockholders' equity? And in this case, when I say stockholders' equity, I'm looking at the capital invested by the shareholders. That is your common stock, any excess capital invested by the shareholders, as well as your returned earnings. And then we're going to also look at the profitability available to cover your interest charges. Okay? So, how much are your borrowed funds compared to your assets? How much are borrowed funds compared to your stockholders' equity? And then lastly, how much profit do you have to cover all of your fixed charges? That is your interest, your lease payments, your preferred stock dividends, as well as any fixed charges that you have on your books. So these are the first three basics ones that we're going to look at. The debt ratio, total debt over your total assets. This is going to measure to say, for every dollar of your assets that you have, how much do you have in borrowed funds? The next one, debt to equity ratio. Again, in the simplest way of saying it, for every dollar of the stockholders' equity, how much do you have in borrowed funds? And then your times interest earned ratio, or we're looking at for every dollar of your interest charges, how much do you have as your earnings before interest and taxes to cover that dollar of your interest? Okay. And then lastly, the fixed charge coverage ratio. It looks at your earnings before interest and taxes. We add back your lease payments. How much is that? How much does that cover all your fixed charges? That is your interest, lease payments, preferred dividends, as well as the funds that you set aside to liquidate your long-term liabilities. Let's do the example now. The very first example will be your debt ratio. Home Depot, the example that we've been looking at in the other financial evaluation topics that we've looked at. So to my left here, you have your liabilities, your current liabilities, long-term liabilities, and your total liabilities. And then to my right here, I have the assets of Home Depot. This is 2016. This is 2017, 16, 17. We are comparing these to the numbers at the bottom. These are your assets, and these are your liabilities in that formula there. How do these numbers look like when we do the calculation of our total debt ratio? 2016, Home Depot, 0.90. 2017, 0.97. What does that mean? It essentially means that every dollar of the asset that Home Depot had in 2017, they had 97 cents in borrowed funds. In other words, if we could liquidate Home Depot at the value of their total assets, per dollar of their total assets, if we liquidated it, they'll be left with 3 cents that the shareholders walk away with. But obviously, when the company is going to be liquidated, for the most part, the assets will fetch less than the value that they show on the books. Well, sometimes they will fetch more, but for the most part, they'll fetch less, especially if they're equipment and stuff. Okay? So, in 2016, again, the same explanation. For every dollar of the assets that Home Depot had, they had 90 cents in borrowed funds. Now, I've always emphasized that when we do financial evaluation, we always have to have a target. We always have to have a comparison point. We have to compare to the industry. And in this case, I wanted to compare to the immediate competitor to Home Depot, which is Lowe's. Lowe's, for the same 2 years, in 16, had a 0.81. In 17, 0.83. Obviously, when you look at Lowe's and compare the two numbers, this is much better than that. Okay? Because here would say that for every dollar of assets, Lowe's had 81 cents in bought funds. And in 2017, they had 83 cents per dollar of their assets. The debt to equity ratio. We're comparing total liabilities of a company to the stockholders' equity. What is stockholders' equity? Stockholder equity comprises of the common stock, any additional capital that the investors have put in the company. Return earnings are part of stockholders' equity. However, look at Home Depot. Home Depot has additional line item called treasury stocks. What is treasury stocks? Treasury stock is a value generated by the company repurchasing their own shares from the marketplace. When a company issues shares in the primary market, when you and I purchase the shares, that share moves in the secondary market. And at any point in time, the company can go in the secondary market and repurchase their own shares. Now you can see that these values are much, much higher than the capital invested here by the shareholders. The reason being, when the share is issued, it could either appreciate in value or depreciate in value. But in this case, with Home Depot, the shares have appreciated so much in value. When the company tries to repurchase those, they are paying a lot of money to actually purchase those. Now, every repurchased stock goes as a debit on the equity side of the balance sheet, and therefore it reduces the stockholders' equity. So you can see that the stockholders' equity total is only $1.4 billion in 2017 and $4.3 billion in 2016. Why? Because the company has repurchased the shares at much, much higher value than the company than the shareholders actually invested in the company. So we're going to compare these numbers here that I've highlighted and those numbers. Let's see, how do they look like? So in 2016, we're saying for every dollar of the stockholders' equity in 16, Home Depot had $8.92 of borrowed funds. In 2017, for every dollar of stockholders' equity, they had $29.63 of borrowed funds. Well, how does the industry look like? The TTM trailing 12 months, the industry was at 0.26. It basically means for every dollar of stockholders' equity, industry-wise, they had 76 cents, which is more reasonable. Well, obviously, we know the reason why these numbers look like this. It's because the company is repurchasing its own shares from the market because they're restructuring their capital structure. And I looked at the numbers and see, without repurchasing, these numbers would have been around 0.85, 0.86, which still would not be better than the industry average. Times interest earned ratio, measuring the profit available to cover the interest charges. Here's our little income statement for Home Depot. 2016, 2017. The operating income. Now, most businesses, the operating income is also the earnings before interest and taxes, because after that line item, then you see all the interest-related charges. So we are comparing that number there, those numbers here, comparing to those numbers. And here are calculations. 2016, 14.35. 2017, 14.93. Now, in simplest terms, what do these numbers mean? This essentially means that every dollar of the interest charges on the profit and loss, for every dollar of the interest charges on Home Depot's books, they had $14.35 available to cover that interest, which is really impressive. Okay, it improved in 2017. Okay, these numbers are quite impressive. However, they're not better than the industry numbers. The industry has better numbers than Home Depot. Okay, but these numbers are still solid. Okay. Now, as always, financial ratios, financial evaluation. You cannot look at financial evaluation in isolation. You have to have a target. You have to compare to the industry average. You also have to compare to either company policy or compare to the next competitor. So let's quickly look at some of the key ratios. We compare Home Depot, Lowe's, and the industry. Just the debt to equity ratio, and I've talked about Home Depot, why the numbers look this horrible, right? And I say without the company repurchasing their shares, this would have been 0.85, 0.86. Okay, Lowe's, these numbers are what they are. Okay, and then the industry is a 0.76, which is much better than both of them. And then times interest earned ratios, which basically shows how much funds, or the ratio that measures that every dollar of the interest charges on the books. You have $14.35. If you want, that's how you can, it's the simplest way of explaining it. These numbers, they're impressive numbers. However, look at the industry. The industry is over $20. And obviously this is TTM, which is the trailing 12 months. So the last 12 months, this is on average, the industry has $20 of the earnings before interest and taxes to cover every dollar of the interest charges. I hope this gives you a picture of the financial leverage evaluation. Now, every one of those, you can take them to the next level by looking at maybe the total long-term liabilities, instead of just looking at the total liabilities. In my calculations, I was using total liabilities. You can look at just the long-term liabilities and then measure out and then compare out to the industry and the next competitor. Next time, we're going to look at profitability. Important measure of a business existence. Again, I hope this makes sense. And as usual, please subscribe and give it a thumbs up and share with your colleagues. Thank you.